Hello and welcome to Moneylife News and Views. I am Debashis Basu. Until the middle of February, the Indian stock markets were doing absolutely fine. On 13th February, the Sensex hit a high of 41,709 and was all set to cruise higher on the back of continued flow of investments from the foreign institutional investors and domestic mutual funds. Institutional investors, market commentators, and of course retail investors were completely unworried. This was a lovely bull market in the making. Economic growth had hit 2.5%. Yeah, it is 2.5%, not 4.5% based on the previous series, all right? But that seemed to be a non-issue. The market players continued to believe that the political leadership is visionary, although it is now focused on social engineering and not on economic development. Record unemployment didn't seem to matter, and the decline in growth of one sector after another, from the autos to capital goods to exports to textiles, were all considered to be a temporary phenomenon. An uninspiring budget and the subsequent fall in stock prices was a reason to buy, not sell. Of course, if you ask analysts, the market is cheap based on some fantasy earnings growth of 2021. It's of course another matter that consensus earnings forecasts of analysts are always wide off the mark. Well, this bullish scenario has now got infected by coronavirus, and the cozy complacency in the market has fallen apart. Last Friday, the Indian stock market crashed to hit the lowest circuit breaker as panic gripped the world markets all over. From the high of 13th February till the lowest trading point of Friday, the Sensex has fallen by 29.5%. This is surprising and even shocking to many, but not unprecedented. The same thing had happened in 2006. From a high of 12,671 on 11th May 2006, Sensex had crashed to an intraday low of 8,799 on 14th June, a crash of 30% in just 1 month. These kind of things happened in the stock market. But I can bet that many seasoned market players even may not remember that 30% market crash over a month, let alone remember what had actually caused it. Along with the equity markets, crude oil prices also crashed this time. Financial experts immediately put a positive spin on it, saying that falling oil prices are going to benefit India immensely. This is silly for two reasons. One, falling oil prices are extorted away by the government through higher taxes. They just don't benefit anybody. They're rarely passed on to the consumers and industrial users and businesses. The Modi government has done this in 2015, in 2018, and again this time. Two, to say that the oil crash will benefit India is selective and self-serving, because that presupposes looking at only one part of the equation. Oil prices crashed because of fears of severe global contraction and demand recession. Now, surely you cannot look at falling oil prices in isolation and thinking that it's positive without factoring in the fact that entire businesses may be shut down and many others may get severely hampered due to demand recession. Now, businesses usually don't care about input cost as long as there is a solid demand growth. But if there is a demand slowdown, then a lower input cost really doesn't quite help. And that's the situation now. The real issue is whether the coronavirus will be stopped or effectively contained. Cities and countries are shutting themselves down one after another. Schools, colleges, leisure and entertainment centers are closing, conferences are getting cancelled, and international travel has collapsed. A simultaneous global containment is the need, as the experts say. But in a globalized economy, it also means a simultaneous global contraction in trade, transport, and tourism, a sure recipe for a recession. It depends on how long this lasts. The US government has tried to ease the pain by cutting interest rates, taxes, and loosening monetary policy. But of what help is fiscal and monetary policy when there is no incentive to do more business and there are enforced hindrances all over the world at the same time? Now, are the markets overreacting to all this? On Friday, the Indian markets were locked in lower circuit, as I said, at the opening, and leading to a mandatory halt in trading for 45 minutes. But just before they were to reopen, the US index futures shot up based on some flimsy government announcement and which reverberated across the world. But just before they were supposed to reopen, the US index future shot up based on some flimsy government announcement, and this reverberated across global markets, pushing everything into green. So the Indian markets reopened to a massive rally. It seemed like a bipolar market, depressed 1 hour and euphoric the next. For instance, today again, the market is very, very sharply down and giving up most of the gains of Friday. This perfectly sums up human reactions to known unknowns, and that's when we overreact. We know that the epidemic will affect us, but don't know how much, so we lurch from one end to another. When we think it will affect severely, that we fear, we sell it in panic, and when we think it's going to be contained, and we get euphoric, we perceive a buying opportunity. Human beings hate uncertainty and react very, very strongly to it. The greater the uncertainty, the stronger is the reaction, and the greater is the market volatility. Now, since the market has fallen quite a bit, there are a lot of queries about whether we're going to see further fall or not. I have to look up to something that Goldman Sachs has done, a research that they conducted over 100 years of US market, and we have a much shorter market history, and they say there are 3 types of bear markets. One, driven by a specific episode or event, like a war, a short war, or an oil price shock, or an emerging market crisis, and so on. It could also be events like demonetization, which we saw, or 9/11 in the US, which is a very, very specific event. And these kind of things last for a very short period. And we don't know how much the market will fall, between 10 to 20%. The second is cyclical, caused by a change in economic cycle due to factors such as rising interest rates, impending recession, and fall in profits. This kind of bear markets can lop off 30% or more, and this is exactly what has happened in the US and India and other markets in the world at this time. So we are already in the cyclical or cyclical fall category. The third type of bear market is a structural bear market, when something deeply, fundamentally is wrong with the world or with a particular economy, and that is usually created by huge imbalances of the previous years and financial bubbles, very often, which is followed by a price shock and deflation. That is really a bad scenario. Now, those kind of bear markets run for about 57% down on an average. The Indian market fell about 60% in 2008 over the course of 10 months. Now, which kind is the current one? I'm guessing that institutional investors would think that this is an event-driven one, not a cyclical one, which we saw, where we've already down by 30% or so. So it's of that category, the second type. Now, my point is we just don't know, because what is happening around the world is so deep and so pervasive that it could well be the third kind, which is 55 to 60% down. The fact is we just don't know. If the epidemic is contained in a month or two, we have a huge buying opportunity. And if not, we are staring at a very, very serious global economic crisis simultaneously happening across the world, the impact of which we are totally unaware of. Thanks for watching.